Access to the cash value inside of your whole life insurance policy is one of the most powerful elements of whole life insurance in general. Unfortunately, people wildly misunderstand what whole life insurance actually is and how it functions, and they equate the returns of the cash value inside of a policy to an investment. And when you do that, then you're really not understanding how whole life insurance works, how it should be utilized as an asset in your life, and you don't realize that whole life insurance is not an investment at all, and it should never be considered as an investment or compared to an investment. That doesn't mean that the access to the cash in the policy isn't an extremely powerful asset in your life. So in this video, what I'm gonna do is I'm gonna talk about the 3 major benefits of the cash value inside of your whole life insurance policy that you need to understand. And I think when you do, you'll realize exactly how powerful this asset can be for you at different stages of your life. So if you haven't already, make sure you subscribe and hit the bell, that way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. In this video, we're gonna be talking about the 3 elements of cash value life insurance, or the cash value inside of your whole life insurance, that you need to understand how it works. And I think when you understand these elements, it's going to make a drastic impact on your perspective of the cash value, how you utilize the cash value, the different roles that cash value can play in your life, and get you outside of the common thought that whole life insurance is just a bad investment alternative, because it's not an investment alternative at all. I think the first and foremost thing that we need to cover here as we get into things is start realizing what is the purpose of the cash value in your life insurance policy. First and foremost, you're not going to create wealth utilizing whole life insurance just because of the whole life insurance policy. The whole life insurance policy is not your investment. It's not the investment at all. It is simply an asset. It's a holding tank, a storage tank for your capital that you can utilize for other investments. At the end of the day, the policy itself, the account, the cash value inside of your policy is not the actual investment. And that's important to understand. So then the question is, well, what's the purpose of the cash value in this policy? Okay, so the purpose of the cash value is to realize that I need to have access to money for emergency. So it's a great emergency fund alternative, right? That's the difference. When you think about what is the money in my whole life insurance policy, it is a savings alternative. And the difference between a saving alternative and an investment alternative is simply a function of risk, right? And I think that's really important to understand. If you can't lose money in the policy because it's got guaranteed returns, and they've paid a dividend every single year for 100+ years straight with any of the legitimate companies out there, the participating mutual companies, well, there's not a better, more safe place to keep your capital and manage your long-term risk on the safe money that you have and that you need access to with a lower standard deviation than whole life insurance policies will provide, right? So I think that's really important to understand. So from my perspective, I look at it and I say, all right, I want to have an emergency fund first, and then, maybe I want to build an opportunity fund if that is where your skill sets and your investor DNA kind of lines with, right? And when you look at it from that perspective and you say, maybe you're a real estate investor, you're an entrepreneur, business owner, something of that nature, well, if you fall into that category, then having access to an opportunity fund has more value for you than maybe if you're a W-2 employee and aren't really going to take advantage of the opportunity. Maybe you just say, hey, I'm going to invest, I'm going to save money in my whole life policy, I'm going to get my emergency fund capitalized, and then I'm going to actually invest maybe in other things, stocks, investments, whatever it is for you. It doesn't really matter as long as it's in alignment with your values and beliefs. So that is what I want to say to get this going. And now that we understand that whole life insurance is not an investment, it's an actual savings alternative, now we have to look and compare it to other assets that have the same risk profile as whole life insurance has. What we would have here, I'm gonna go to the board here actually. Hey, I hope you're enjoying the video so far. Check this out. I'm doing videos like this all the time. I really, really encourage you. If you wanna learn more, if you're an agent or if you're somebody who's looking to get a policy for yourself, I encourage you. I have videos like this coming out every single day. Click on the button below. Make sure you subscribe, hit the bell, that way you're notified, because I have these videos coming out. This is your financial future on the line. This is your business. We have an obligation to do what's right for our families. You have an obligation as an agent to make sure that you understand this stuff. And I don't think you're gonna find anywhere else on the internet that is more dedicated to educating you as either a client or an agent to help you serve people, your family or your clients in a more powerful way. So once again, sign up below. And if you have any questions, always comment in the comment section. I handle all my own comments. I don't outsource that. And so honored to serve you. Let's continue the video. And I'm going to create another thing. Let's go down here and let's go right to there. So, all right, so let's take a look at safe assets. What are other safe assets? We have savings accounts, savings account, bonds, CDs. These are pretty much the three winners in that category. Now, when we look at this, we go, all right, well, savings account, right now, savings accounts, you can get money market accounts that are paying 5 to 5.4% on the high end if you have a good amount of money. High yield savings accounts are in the 4 to 5% range. Bonds, the yields are going up. CDs are going up. At the end of the day, the fixed market is getting better right now. And what's interesting to me is that I've got some content that's several years old that's talking about whole life insurance as an alternative to save money that people are ripping me on because they're saying, oh, don't you look stupid because you were saying that whole life insurance will get you 5 to 5.5% long term, while bonds were only getting 2.5 to 3%. Well, don't you look stupid because now these bonds are getting 5.5 to 6%, right? And so they're like, well, you're an idiot, and that's why whatever, whole life sucks. That's basically what these guys are saying. At the end of the day, whole life insurance, the dividends and the returns inside of whole life insurance are going to trail the fixed market. As the fixed market goes up, whole life insurance will lag and will go up with it. But at the end of the day, the reason that we want whole life insurance to be our safe, liquid, accessible place to access money is because the standard deviation is going to be lower than lower than virtually any other account. What we have to take into consideration here is that long-term with savings accounts, I understand people can get this right now, but the reality is long-term, if you can get 2% in a savings account, that's pretty lucky. If you looked at most savings account 2 or 3 years ago, there was like 0.1%, right? So one of the phrases that I utilize a lot is you can't solve long-term problems with short-term thinking. And at the end of the day, we have to be thinking long-term. I don't care about, if I'm 43 years old, which I am, I don't care about what happens over the next 1 to 4 years. I care about what happens over the next 20 plus years because I'm going to need access to this safe capital over a long period of time. And I want to maximize my returns over that period of time. And I understand that the interest rate environment is going to kind of do this, right? And so what I want to do is I want to level that curve out. There are going to be times where I have worse returns on my whole life policy right here than I would in a market, but then there are going to be other times where I have better returns in my whole life policy than I would receive in bonds or in a savings account or anything like that. And at the end of the day, when you look at a whole life policy, it's going to be more liquid than bonds, and it's going to be obviously about the same liquidity as a savings account. So now that we understand this and I've gotten this down, what I want to really focus on is the 3 real benefits. And I'm going to land the plane with this because this is the real value that you need to understand is that your long-term, okay, this is what we need to think about. Long-term, we're going to have bond-like returns with a lower standard deviation than traditional bond portfolios that got hammered over the past couple of years. And because they got hammered, the 60-40 portfolio of bonds being 40% of your portfolio is getting decimated right now because for the first time ever 2 years in a row, we've had bonds lose money while the market lost money at the same time. So people's retirement accounts are getting absolutely obliterated. The second thing is municipal bonds, municipal bond tax treatment, like tax treatment. So your money's gonna grow tax deferred and you have tax-free access to it inside of your whole life insurance policy. That's extremely powerful. And then the third thing is you're gonna have money market-like liquidity. And when we look at this, and we look at these 3 benefits right here, the fact that you get bond-like returns with a lower standard deviation than a bond portfolio. That's really powerful. But not only do you do that, because most bond portfolios are not going to have the liquidity that you would have in a money market account. So you get the best of both of these worlds. You're going to get the bond-like returns with the long-term bond-like returns with the short-term money market-like liquidity. And then we're also going to tap in the fact that we get muni bond-like tax treatment. And when you combine those three elements and you combine them together, and then you tack on top of it, and it's not what this video is about, but when you tack on top of it the life insurance backstop and the living insurance, the living benefits riders that go with it for if you become critically, chronically, or terminally ill when you're in retirement, the ability to utilize this as a bond alternative in your life and replace the bond portion of your portfolio in retirement and utilize this as a strategy. And then when you tap in the death benefit and the living benefit riders that go with it that will help protect you even more in retirement, it makes just such an impact on your ability to have a predictable retirement income and to be able to plan more effectively for the ups and downs of the market. Because the reality is right now, if you have a couple that's hitting 65 and retiring at 65, there's a 25% chance that one of you is going to live to at least 92 years old. There's a 25% chance that one of you is going to live to 92 years old. That means you need to bank on your money basically lasting 3 decades. And if you don't have it set up where your money's lasting 3 decades, there's a significant chance that you're going to have to take a drastic step backwards in standard of living in retirement. And so, I just look at this and I say, well, it just makes sense. If you understand that we cannot compare whole life insurance to an investment, we have to look at it as a savings alternative, and then we compare it to the fact that we have short-term needs right now. You have an emergency fund need, you have the liquidity need. Right now, if you're going through your savings years and you have a family and all this stuff, you have a life insurance desire probably, but then when you hit retirement, the asset actually pivots in how you utilize it and it becomes your bond alternative. So you have this one asset that can solve different needs for you, different phases of life, if you just think about it not as an investment, but instead as a foundational asset that can help you solve all these different problems as you go through life. And the only thing that you can do to prevent it from working for you is just not participating in it and not executing, not saving, which is a crisis on its own. We have such a huge savings crisis in this country right now. That's a big driver to a lot of the problems that we have. So hopefully this helps. Hopefully it makes sense and gives you some clarity on the different ways that you can utilize whole life insurance in these different ways. But I think it's important to understand how the cash value works and what some of the benefits are, and understanding the moving parts and the features of that cash value. It's just vital, because now that you understand it, my guess is it's a bit more appealing to you. And if you have any questions and you want to have a conversation, if you still have some lingering questions and would like a little more clarity, I invite you, go down below, set up a clarity call with somebody on my team. They can walk you through. It's not a sales call. They will just help you answer the questions that you have. If it makes sense to work together, get a policy or whatever for you and your life and your situation, then we can evaluate, we can look at that. But the goal is just to give you the education that you need to make the best informed decision for yourself. And that's it. So hopefully you found value. If you did, please like the video, share the video, get it out there, subscribe, hit the bell, all that fun stuff. And until next time, have a blessed, inspirational day. We'll talk soon. See ya.